Every trader, no matter how experienced, has been caught in the emotional tug-of-war between greed and fear. One moment you're riding high, convinced the market is your playground. The next, you're frozen, terrified of losing it all. This isn't just bad luck, this is the greed versus fear cycle. And unless you learn how to master it, it will master you. Let's be honest, trading isn't just numbers on a screen, it's emotions in motion. Behind every chart, every candlestick, and every trade is a human brain struggling to make sense of chaos. And that brain? It's wired with two primal forces: greed and fear. Greed pushes us to chase profits, often beyond reason. Fear pulls us back, making us doubt our decisions and sometimes keeping us from taking opportunities. Together, they create what's called the greed versus fear cycle, the emotional pendulum that swings back and forth, often leaving traders exhausted, broke, or both. Why does this matter? Because whether you're day trading Apple stock or just dabbling in ETFs, your success isn't only about knowing technical setups or reading financial statements. It's about knowing yourself. The market is a mirror, and it reflects your psychology as much as it does economic reality. Fail to recognize that, and you'll find yourself stuck in the same loop, buying high because greed whispered, "Don't miss out," and selling low because fear screamed, "Get out before it crashes." In today's episode, we'll break down exactly how this emotional pendulum works, why smart traders fall for it, and how you can stop being its puppet. We'll use real-world examples, practical strategies, and maybe a bit of tough love, so that next time the market plays tricks, you'll keep your head steady. Before we continue, I want to thank the sponsor of today's video, Noesis. Noesis is a platform built specifically for traders who want to level up their consistency and mindset while avoiding mental pitfalls. It gives you tools like a daily mental check-in, a trade journal, and an emotion wheel to track your state while trading. On top of that, it includes structured playbooks, which are strategy checklists that you can go through before and after each trade, plus a playbook marketplace where you can explore proven strategies from other traders or share your own. If you're serious about developing the psychological edge that most traders ignore, Noesis is worth checking out. You can get started today at noesis.zone, link in the description. The cycle explained. Think of trading emotions like a pendulum. On one side, greed. On the other, fear. When prices rise, say Apple jumps 10% after a strong iPhone release, greed takes the wheel. Traders convince themselves, this can't stop going up. They pile in, buying at inflated levels. That momentum pushes prices even higher, validating the decision. The pendulum swings harder toward greed. But markets are never straight lines. Eventually, profit-taking kicks in or bad news hits. Suddenly, the stock dips. And that's when fear creeps in. Traders who bought late panic. Instead of seeing the dip as a normal correction, they see disaster. What if it crashes back to last year's levels? Fear pushes them to sell, often at a loss. The pendulum swings back. Here's the kicker. The cycle isn't about the stock, it's about perception. The same 5% dip looks like a healthy pullback to a disciplined trader, but like the end of the world to someone caught in the fear loop. Real-world scenarios. Let's rewind to Tesla in 2020. The stock exploded, rising over 700% in a single year. Greed took over. Investors convinced themselves Tesla was unstoppable. Forums buzzed with predictions of $10,000 per share. Some people mortgaged homes just to buy more shares. That's greed in overdrive. But in early 2021, when the stock corrected by nearly 30%, fear took the stage. The same people who were chanting "to the moon" a few months earlier sold in panic, locking in big losses. Those who stayed calm? They still came out ahead in the long run. Or look at Apple. In June 2022, AAPL slid from $180 to $130 during a market-wide tech sell-off. Fear dominated. News headlines screamed about the death of tech growth. Many traders dumped shares at the bottom. But Apple wasn't broken. It was just caught in a market cycle. By January 2023, it was back above $150. Those who let fear dictate their actions sold at the worst possible time. These examples prove something critical: the greed versus fear cycle doesn't care how smart you are. how many books you've read, or how many trading tools you use. If you don't control your emotions, you'll get chewed up. Why it happens. So why do our brains fall for this every time? Evolution. Greed and fear are survival instincts. Fear kept our ancestors from getting eaten by predators. Greed pushed them to store more food than they immediately needed. In trading, those instincts misfire. Markets aren't jungles, but our brains treat them like they are. Another factor is social proof. When everyone on social media is screaming, "Buy now," it's hard not to feel greedy. When CNBC flashes red banners saying, "Market meltdown," fear spreads like wildfire. We're wired to copy the crowd, even when it hurts us. And then there's loss aversion, the psychological truth that losing $100 feels twice as painful as gaining $100 feels good. This is why people panic sell in downturns. The pain of losing overwhelms logic. Common pitfalls. Let's go through the traps traders fall into when caught in this cycle. Buying tops out of FOMO. Greed convinces you that if you don't buy now, you'll miss the rocket. Reality? You're often buying just before the pullback, selling bottoms out of panic. Fear tricks you into thinking a temporary dip is permanent. You lock in losses, only to watch the stock rebound later. Over-leveraging. Greed whispers, "Double down." Suddenly, you're trading with borrowed money. When fear inevitably returns, your losses are magnified. Ignoring plans. A trading strategy only works if you follow it. But when greed and fear take control, traders abandon stop losses, chase random setups, or freeze in indecision. How to break the cycle. Here's the good news. You can't eliminate greed or fear, but you can manage them. Here's how. Have a trading plan. Before you click buy, know your entry, exit, and stop loss. Write it down. That way, when emotions flare, you have a rulebook to follow. Use position sizing. Never risk more than you're comfortable losing. If a trade feels like it could ruin your week, your position is too big. Detach from the noise. Limit how much you scroll Twitter or watch financial news. Constant headlines fuel the pendulum. Journal your trades. Write down what you felt before, during, and after each trade. Patterns will appear. You'll see where greed or fear hijacks your process. Practice patience. Sometimes the best trade is no trade. Wait for setups that align with your plan instead of chasing every move. Noesis, the sponsor of this video, is the only trading journal focused on the mindset of the trader. You can easily journal emotions in your trades, and you can also find strategies from their selection of playbooks to avoid falling into greed or fear. Remember to check the link in the description. With discipline, the pendulum slows. Greed and fear still exist, but they stop controlling you. The greed versus fear cycle is the oldest trap in trading. It doesn't matter if you're buying Apple, Tesla, or some tiny biotech stock. It's the same story. Greed tempts you to buy high. Fear pushes you to sell low. The market doesn't have to beat you. Most of the time, you beat yourself. But when you recognize the pendulum and learn to step back, you shift from being its victim to being its master. Trading then becomes less about riding emotional waves and more about steady decision-making. And that's where consistency and profit are found. If this episode made you reflect on your own trades, you're not alone. Every trader battles greed and fear. The difference is whether you let them drive the car or just ride in the back seat. If you found this helpful, hit like, drop a comment about your toughest emotional trade, and subscribe to No Markets for more on mastering trading psychology. Next time, we'll talk about overconfidence, the silent killer of consistent gains. Until then, remember, the market will test your emotions, but it's your response that defines your results.